This is our Forex blog for October 21st, 2011. And like most days, we really want to buy the strongest currencies versus the weak and sell the weakest ones versus the strong. We also would prefer when a currency real-time weakness, like the dollar from 1 to 2, the intermediate daily, weekly, and monthly time frame trend is down. The more time frame trends that are moving in the direction of the real-time trend, the higher your odds and the greater the chance of catching pips. So you saw about an hour of weakness here, and then about 2 hours of strength, followed by an hour of weakness. When very little strength comes in right here, and the longer time frame trend is down, and the last very high momentum move was down with 1/2 to 1/3 less momentum in the counter trend trade, it's pretty safe to assume that the trend will resume down. That's how you can use this to anticipate future trend moves, and therefore catch a lot of profitable trades. You're always going to have times where you get short and the trend only lasts 5, 10, 15 minutes, 30 minutes. You might get out with a 5 pip win, a break even, or a 5 or 10 pip loss. It doesn't work all the time, but the vast majority of the time it does. And as you can see here, this trend lasted for about 3 hours, 3.5 hours. And so when you spot another currency where the weekly and monthly trend is up, the real-time momentum is up here, as you can see. This was a pretty high probability Australian versus a dollar. Now the euro had a little bit of strength and weakness, a little bit less strength than the previous weakness. You can see it went weak for about an hour here and then got strong. But for the most part, the strongest two currencies of all of them were the Australian and the pound. All the time frames of the pound are up. This one was a very high probability trade versus the dollar here at 7 o'clock. And even before that, you had incredible strength followed by very little weakness. The strength is likely to resume, especially when the longer term time frame trend is up. So really, even coming up to 6 and also 7, the pound was the best, #1 highest odds trade. Let's take a look at this. First of all, the price for almost the entire day was above the hourly moving average. And when a currency is above the hourly, it's more likely to go up. And you can obviously see this is most likely due to a news event, but it did shoot up 100 and something pips. Now when it's above the upper containment band like this, you really want to be really cautious in buying that. But you can see this trend just continued and continued and went up 150 pips. Most of you are going to want to use our range charts to find very high probability entries. If you missed the beginning part of this move, it's very hard to get into the trend until maybe here or here. Using a range chart, you oftentimes can get into pullback trades very easily. Let me move some of these things away. Here's the hold on one second. Find the pound dollar here. This is our 6 pips per bar range chart. And notice, again, this is also using a different tool than you saw in our currency meter. Build your own trend. You can take our best statistical trend tools and create your own real-time histogram showing the strength. 15% weight with the trend candle set at 5 minutes. 15% weight of what percentage of currencies are above their 15-minute bars 20 period average, and so forth. Most of these tools measure direction, and the bottom two measure intensity of direction. And as you can see, I have the intensity weighted 45%. So if currencies are all going up, but they're just going up with light intensity, you're not going to have any severe readings. And you could really see here the first intense reading was approximately around 5 o'clock. It broke from underneath above the hourly right here, and you might have, when it came down and retested right here, got long. You didn't really make much on that trade. You might have went long here at 90 and got stopped out at 03. You might have bought this pullback right here and broke even, and then you can see it just exploded up. We would have actually been into this trade even before the major part of the move. And notice how our new intelligent trailing stop keeps you into this move all the way right up to the high. 59.07, get you out. It's one of the tightest stops you're ever going to find in any software platform, and because it's based on all of our statistical and intensity tools. if the trend's going up with incredible percentage participation, in other words, the pound's going up against every other currency, or even 80% of them, the dollar's getting weak against 80 to 100% of them, and the intensity of the pound going up and the intensity of the dollar going down is huge, we're going to have a wider stop. Once it moves statistically too much, above the upper containment bands, we tend to stop even more. But on the strong trends, it still tends to keep you into the move. And when you're outside the containment bands, if you want to look to buy the pullbacks, this also makes a pretty decent tool. You got a small, maybe 5-6 pip loss there. Another small loss. Usually when the currencies are up this much, they're either going to go sideways for an hour or two, or you get a pullback. I would wait for it to go sideways and then break out right here. So we're long right around 59.05 and out at 22 for a 17 pip profit. A little bit of a pullback. I prefer pullback trades. And when it pulls back and goes sideways, it's even higher probability. You can buy it when it goes a pip above this range right here at 17. Trailing stop still in it. Hasn't stopped you out yet. And then you're out here with a very, very tiny profit. But one of the best ways of using the range charts is, if you, sometimes these things go up, go sideways for a couple bars and break out, like right here. It's not too late really to buy this when it's below the white band. And you could have got in here, even if you missed the first trade, in this trade around 66, out at 06 for 45 plus pip move. That's just one currency trade today. We also saw the Australian was extremely strong over the weekly and monthly, and it also became strong here at 7. Let's take a look at the Australian dollar. Now this is a nice pattern right here, because if you had bought this, or if let's say you had missed it, went up to the previous day's high, and it has one of our criteria for re-entry. You either get a pullback after a strong move up, or you get kind of like an hour and a half sideways move where it breaks out, and then you can draw your fibs off the first wave, and it tells you where your likely profit target is. Here's your 1.318 fib target. It's above the 1.5 containment band. It looks like the previous week's high is right there. There's a lot of reasons why this is likely to stall here, and you would probably want to exit half your trade around 50. You might have gone long here at 99 for a 50 pip win. Let's take a look at the Australian dollar on a range chart from about 6:30 to 10. Okay, so here's the same chart using 6 pips per bar instead of a time-based one. And let's say you missed the first move, which a lot of times happens. You go get coffee or eat breakfast, or you're reading the news waiting for a high probability trade, or surfing the web, whatever. You miss the trade for whatever reason. When you see incredible strength like this, the pullback trades are likely to work. So even if you got in here and got out at the double top right here, you made about 20 pips on that trade. And you can see, it's kind of stalling at the previous day's high. It hit it again, had a false breakout. Usually false breakouts, when they come back down, they will go below the previous low, which is down here at 73. In this case, it didn't, and you can see the weakness on the way down is 1/4 the peak strength. This trend's very likely to continue. It's not above our upper containment bands, and so most of the time you're going to buy this pullback right here, and you can either take every trade on the way up. In this case, it was kind of a choppy trade up, or just kind of set your stop underneath here and set this as your target at 30. If you got out at 30, you made 40 pips. If you traded every little wave, you made maybe 10 pips here, 5, 5, And once it gets up to that level, you don't know if it's going to continue, but you can see the real-time strength is just incredible. Once it gets above the upper containment band, a lot of times it runs out of steam. The Australian was no longer the strongest. Well, actually, the pound was stronger than that, but those were the highest probability trades. You can also use the currency meter to scalp lower probability trades. For example, the Swiss. It's pretty much weak. You can see a little bit of strength here. When the strength is less intense and for less amount of time, this is about a 40 minutes of mild strength, preceded by an hour and 10 minutes of weakness. It's pretty safe to assume, once that strength kind of subsides, that the weakness will come back. Now, in this case, the monthly trend's down, the weekly trend's up, so just trade that as a scalping type trade. But it stayed weak until for about an hour and a half. At 5, one of the strongest ones was the pound, and so therefore the pound Swiss would be a pretty decent scalping type trade. And some of these scalping type trades, can move 30 to 50 pips. You just don't know ahead of time whether that's going to be the case or not. But coming up to 5 o'clock, a weak Swiss, very easy to predict based on its pattern. Strong pound, and you can see you had this nice little pullback right here, and you were anticipating a move up after the pullback, and it did. You can see, even if you got out of it somewhere right here at 69, you're in around 55. You made 14 pips. You also have a nice little breakout pattern right here, which shot up about 25-30 pips, 35 pips or so. And you can see it just continued up. That's how you can use the currency meter, even when you don't find perfect trades like the pound dollar and the Australian dollar today. You can anticipate future trend direction based on what the patterns is. For example, the CAD, incredible strength right here, 15 minutes of the most mild weakness. The weekly trend had shifted up. It's likely for strength to come back. Now in this case it only came back for about 20 minutes, but you might have been looking to buy the CAD versus the weakest one. At 7, the dollar, without a doubt, was the weakest one. So, coming up to 7, the dollar CAD is likely to fall. Again, you're not always going to catch 30-40 pip moves, but here is coming up to 7 o'clock. This one had just broken underneath the hourly. You can see it fell from 52 all the way down to 34. So there's some opportunity to make 10-12 pips in there. Came back up a little bit later, hit the hourly, and this is called a retest. When currencies break from above to below the hourly and then come back and retest it, can't get it above it, it's very likely to go down. You can go short right there with your Fibonacci profit target as your likely profit. Let's fix this here. Let me move this over so you can see. This is a dollar CAD, 6 pips per bar, and you can see it went right down to this level here at 13. It's a 30 or so pip move, and our intelligent trailing stop got you out pretty much right here at 09. So even some of the the highest probability trades are when you have real-time strength on all time frames on one currency and real-time weakness on all time frames in another currency. But there's dozens of very high probability 5 to 25 pip moves reading the currency meter that way. Look for incredible strength followed by very little weakness, and that strength is very likely to resume. And even though this had some weakness right here, the dollar was even weaker, and that counter trend move didn't last that long. Remember, that's when the dollar CAD went back up to the hourly, and then it failed, and then it continued down. Even though in the dollar CAD the strength never really came back, you still had a 35 pip move that was predicted by the currency meter.